They've got close to $100 million of net cash on the balance sheet. They've got a huge amount of production growth coming up from a high quality asset. We see that business generating $100 million of free cash flow on what is today an EV of 250 with a substantial mine life.
Happy Friday, Money Miners, and what a Friday it is because we always upload a long-form conversation, and Jonas Benedict Dorling, you've managed to get hold of none other than Matthew Fist, aka Fisty, who we had the pleasure of interviewing like back a year ago with the Livewire guys, and that was just a pleasure. But you managed to pin him down while you're in Melbourne. What did you talk about?
Yeah, it is hard to believe it had been almost a year since we spoke with him, mate, and a lot's happened. And he made some pretty prescient calls back then, which I'm sure was music to his ears for me to repeat to him. But we covered a heap of ground. We started with the macro, but Fisty really works from the bottom up, finding stocks in that small cap space. So yeah, it's hard to miss all the disruptions that have happened across the commodity world and the trade war going on. So we get into that a bit, and then we spoke a good bit about the goldies, which I'm sure people will be keen to hear about. He's long and strong, a few of the names that we speak about quite regularly, and then the conversation sort of ebbed and flowed its way through lithium, uranium. We've obviously touched on Nexgen when we spoke with him quite some time ago, and yeah, a bit sort of happened on that one, and kind of everything in between. So plenty for the money miners to dig into in this conversation.
Fisty, of course, portfolio manager at Firetrail, but didn't he used to be a geologist?
Yeah, geoscientist at BHP of all stomping grounds.
Geoscientist, not geo. Well, I'd still be familiar with this problem that geos and drillers have, I'm sure. You know, when the drill rig is just chewing through bits faster than you can order replacements, I hear it is a nightmare, mate.
I think you're onto something. And there's one company that springs to mind, mate. Black Diamond Drilling Services, BD Drill, our newest partner. We're pumped to promote these guys. They are the go-to name for consumables. So born and bred in Perth, got an office in Sudbury, Canada, distribution hubs all across the world, even your old stomping ground, Trav Kalgoorlie. These guys are no newbies, 30 years in the industry. They are leading the pack at what they do.
They manufacture over 600,000 drill bits a year, I hear, and it's all under strict QA testing. It doesn't stop at bits. We're talking down the hole hammers, drill pipes, subs, casing systems, even complete drill rigs, plus every accessory you can dream of. Mate, what does BD Drill not do?
It does get better though, mate. Their gear goes the distance. It means fewer change outs, lower costs for your operation, and that is one of the reasons why these guys have won contracts with your FMGs of the world, Rios, Newmonts, and heaps more. And here is the kicker. They keep inventory on site and backups in their other hubs. So you are never going to have downtime if you're using BD Drill.
Lower cost per meter drill, mate. Hit up the team at BD Drill. Drill smarter, not harder. JD, let's rip into you.
All right, Matthew Fist from Firetrail. It's been a hell of a past couple of weeks in markets. I thought I'd start this conversation by just gauging the temperature and seeing what the emotions have been like and what the feeling amongst junior portfolio managers has been like over this little period.
Yeah, it's certainly been eventful. Never a dull moment. Waking up to something new every day at the moment, as you know. I think we're measured. We're pretty calm and collected, and we're just taking everything in our stride. I think heading into this period, there was a real sense of complacency in the markets, and people were pretty comfortable with high price to earnings multiples. And I still think there's quite a bit of complacency in that people are expecting a lot of these tariffs to be wound back or policy positions reversed. We're certainly not approaching our portfolio like that, or any of the stocks in our portfolio. We're assuming that this is very much the status quo and making decisions on that basis. But as with all market dislocations, this is what we get paid for. This is what we love doing, and there's a lot of very, very good companies on sale, both in resources and in industrials. So it's the onus is on us as portfolio managers to make the right decisions now that will drive returns over the next 3 years. So it's a great time to be in markets.
Yeah, I'm keen to dive into what you said at the end there. You know, companies being on sale. How are you seeing? And maybe you just clarify up front for the listeners that you're running a small cap fund, so your benchmark is the sort of 300th to 100th biggest companies.
That's right. Yeah, I spend about 30% of my time on resources. So yeah, very much looking across the broader market as well. Yeah.
And how are you seeing sort of valuations amongst that subset versus the bigger names in Australia, and even down the bottom end where you sometimes sort of pick a story nice and early?
I mean, if you believe current market forecasts, then valuations are cheap in resources and in small caps relative to large. But the E or the earnings is wrong, clearly, for many companies out there at the moment, and that's what the market's telling us. So we can talk about price to earnings multiples for cyclical companies across the ASX or in resources, but given what's transpired over the past couple of weeks, those earnings estimates need to come down substantially. And who knows where they'll land, but it's very hard to have a firm view on valuation in these sort of markets. What you can do and what we do is focus on good balance sheets and earning certainty. So identifying those companies that do have earning certainty, because they're going to be rare in this sort of environment.
And you guys sort of by nature are bottom up. You're focused on picking out the companies, right, that you think resources might be a bit different, but in the industrial space, the ones that from the ground up have good earnings. How much time do you actually spend on the macro? Like, it can be pretty tempting just to spend all day, reading what Trump's doing, what Bess and what's happening at a macro level. How do you sort of divide your time at the moment?
Yeah, we don't look at the macro at all. It's very important to understand, where the temperature of the market's at, what you're up against from a macro perspective. But we are all bottom up when it comes to resources and industrials as well. And we're always looking at valuation relative to market. We don't take a view on cash versus fixed income versus equities. We're always 100% equity market exposed. And as much as possible, what we try and do is eliminate any sort of thematic risk in our portfolio. So we're very fortunate in small caps. We can have a portfolio with very high tracking error or very different to the benchmark. And we don't need to take factor bets. So we don't need to be long momentum, growth, value. We don't need to take massive bets on industrials versus resources. We can have a very active and high performing portfolio just with stock specific risk. And that's what we're really focused on and is at the core of what we do.
So stepping away from resources for a moment, if we look at your portfolio, where are you sort of underweight / overweight? I know you'd said in the past that that benchmark is sort of 30% resources, right? And you're about on track. If we look across the spectrum, where are you?
Yeah, that's right. Yeah, so it's dominated by gold at the moment, as you and all your listeners will be aware. The gold sector on our numbers, just looking at the latest numbers this morning, up to 16% or just over 16% of the Small Ords Index is gold, and roughly 30% is resources. We are pretty much in line with that on a benchmark basis. We're not trying to take a view here on macroeconomic factors as we've talked about, but within that we have a huge amount of conviction in the particular stocks we have selected and their ability to outperform both in resources and gold and energy as well.
And just to understand your style a bit more, how do you sort of view a trading mindset versus a buy and hold? What might your turnover be over a kind of year? How do you think about that?
Turnover for us is an outcome. So we're not looking to make decisions based on turnover. We don't try and target a certain turnover. If a stock reaches our valuation, and we do have very, very strong views on valuation, then we will sell. Typically, over the last 5 or 10 years that we've been running the same strategy, turnover has been about 100% per annum, but that will spike materially in times like this where we have a lot of market volatility and if there's a lot of equity capital market activity as well.
I'm curious to learn about the fund and sort of beating your benchmark, which is obviously what you strive to do.
We try.
You've done well at that so far. How does it play in with, say, companies that are falling? There's a few in the resources space that spring to mind.
Yep.
And also the rises. My understanding is that you can play outside the bounds of the benchmark a bit to the upside of your unit holders.
Absolutely, yeah. So as you said, the ASX Small Ords Index, which is our benchmark, is ASX 300 to 100. We're very happy to play below that, and we see a huge amount of opportunity in the microcap stocks. As you know, particularly in mining, it's a very inefficient market. It's under-researched, and that is just amazing. And we can generate a huge amount of excess returns there. I think in resources, that's particularly been the case in the past couple of years in the gold sector in particular. And then we can also choose to invest in the mid caps if we want. So that ASX 51 to 100, we can take positions in that part of the market. Pretty rare for us, but we absolutely will invest there and hold stocks that rip through the small ords and into that mid cap part of the market if we still see some good valuation upside.
And in terms of sort of hedging risk at the moment, I'm kind of curious. It springs to mind everyone's sort of talking about it at the moment. You hear a couple of people that might have called it and they get all the plaudits. It's kind of few and far between. But
Yeah.
do you think about that at all? I know you mentioned before that you don't actually hold a cash pile. You're fully invested.
Yeah.
How do you think about hedging risk? Is it purely from a basis of picking good companies?
When you say risk, you're talking about equity market risk?
Yeah.
Yeah.
Yes.
So we take the view that if people are allocating to our fund, they want equity market risk, they want small cap exposure, and we'll deliver that to them. We'll leave it for asset allocators to decide if they want to be in cash, fixed income. But if they're invested in our fund, then we take the view that they're paying us to be fully invested in equities, and that's what we'll deliver. At times like this, we do have a slightly higher cash component of the portfolio. So typically we'd run 3 to 4% cash at the moment, or as of this morning anyway. We're sitting at about 5%, so slightly overs versus the long-term historical average, but that's fully covered with futures. So it's 100% market exposed at all times.
Yeah. And where we sit sort of today, are you getting itchy to deploy that extra bit of capital?
Absolutely, yeah. It's always tempting, but I think in times like this, sometimes the hardest thing is to do nothing for a period of time and just let the dust settle. There's a massive amount of uncertainty out there, and there are a huge amount of opportunities. It's pretty important to separate out resources here, I think, from the rest of the market, because clearly, resources have their own characteristics that are quite unique. But we are very, very excited about some of the opportunities that are presenting themselves at the moment. And as we talked about prior to this, I've been in WA and Adelaide in the past couple of days meeting companies, which I won't tell you who they are for obvious reasons, but share prices down 30, 40% in the last month alone, and we'd love to own them at a point in time.
Unfortunately, them being down 30 or 40% doesn't really single them out too much in the moment. Yeah, so let's talk resources, right? Let's talk commodities and kind of trace how the broader macro is really playing into the resources. So I think the obvious connections are tariffs bad, China hurts the biggest consumer of commodities globally, and that can really hurt Australia. We've started to see it in iron ore, which had a bit of a delayed response. We've seen it amongst some other sort of commodities, some more dramatic than others.
Yeah.
But what do you make of the notion that this trade war will cause a slowdown for China that's really going to hurt the Australian economy?
I'm concerned about it. Yeah, I think it'd be remiss of anyone not to be. As an Australian, as an investor in resources as well. But I think you need to just take a step back here and look at the macro in the context of the individual companies we can invest in, their position on the cost curve, and what that means for longer term prices. The moves we've seen in copper, zinc, aluminium, in my view, over the past 3-4 days, or 3-4 trading sessions, I should say, don't really reflect, in our view, the fundamentals of what is a pretty tight supply and demand, fundamentally tight supply and demand market. And they're more driven by financial market participation, which is speculating on a global growth slowdown, and that is what it is. But what I'd say, China is the most important consumer of all commodities, just about, particularly the ones that Australia produce. And over the last 20 years, if there's ever been a slowdown in the global economy or in the US, they have not hesitated to stimulate their domestic economy through construction, in property and infrastructure. This will be no different. The Chinese government started that, I think, in September last year. I think we caught up last in late in the year after I just got back from China in November. Rubber was hitting the road then. They've continued that and accelerated it post the US election, and this is only going to add further fuel to the fire. So, I'd say don't get too negative, and particularly don't get too negative on steel making commodities like coke and coal and iron ore. And in a relative sense, they could actually be set up pretty well.
You're a cool head, Fisty. I'm keen to dive into that more, the stimulus part, because one of the arguments that was made at the time, September, when Chinese equity markets rallied really, really hard, sort of 30% over the space of a week, was that a lot of that stimulus was sort of monetary and based at kind of financial assets, as opposed to being fiscal. That's going to, kickstart property development, infrastructure. Yeah. Do you anticipate now that we're going to see more of this fiscal type stimulus that tries to kind of spur demand for commodities as opposed to more monetary side stimulus? Or
Oh, look, yeah, I try not to get in the prediction game too much, even though that's my
I'm
job.
pushing you that way, mate.
Yeah, you're reaching the limits of my macroeconomic prediction skills here. But let's comment about what we're actually seeing on the ground right now, because that's what we can observe and what we can make decisions on as portfolio managers and investors. And what we're seeing, whether it's apartment sale numbers, machinery sales, industry numbers, we're seeing double-digit increases year on year, up to 20 to 30% in some cases. So last year, when we were sitting here talking about potential stimulus in the Chinese economy, it was really reading the policy tea leaves about what could potentially come. Now we're seeing that hit the ground, and it's not speculative anymore. This is really happening, and absent what's happened in the past week in terms of macro shocks, we think the commodities sector was set up extremely well just on that basis alone, and we're going to see further stimulus come through.
Very curious to hear as well from your visit there late last year. What were the other sort of takeaways, whether they be sort of specific to certain commodities or across the board? Were there things that just you didn't kind of realise were as big a trend, or anything else that really stuck in the mind?
Gosh, that's thinking back.
Sorry to put you on the spot there, mate.
That's all right. I have to say it was a pretty good trip in terms of read-throughs and the insights that we got. We spent a lot of time in the lithium market, visiting some mines in a couple of different provinces, going to some car factories, and I came away amazed that they're able to mine some of the grades that they do mine over there, and then do that at a cash cost that makes sense at current prices or slightly above, and the fact that those car and battery raw material supply chains are all within a very confined in a confined space, and so you're going from mining lithium, even though it's low grade, to producing a battery, to producing a car in a confined geographic area with cheap energy, cheap labor, and very good technology. And the competitiveness of the Chinese auto sector and even their lithium mines, I think, is something that we're going to have to learn to grapple with, because the WA mines, they're the high cost ones, I think, when you take into account all the transport and that sort of stuff. So that was a really interesting insight. And as anyone who's seen the BYD cars driving around the roads recently, we're seeing those sales explode
Everywhere.
Yeah, and they're pretty good. Yeah. They're pretty good. One of my colleagues, Blake, has got one. He's got the C line, loves it. And that is just going to be a continuation of I think we're just in the infancy of that.
Yeah, it's crazy. You saw the BYD Shark as well, 6th bestseller in Australia year to date, I think. That's yeah, I mean, we don't quite have the same tariffs that the rest of the world has, but you can see why it's such a important part, because the competitiveness is through the roof, right?
Absolutely. Yeah, I think it's potentially a byproduct of what we're seeing at the moment in global markets is really going to be of the benefit to Australian consumers if we're able to access cheap Chinese EVs and cheap goods that otherwise might have gone to the US.
On the topic of EVs, taking a step back, how do you view the energy transition trend? This was sort of all the rage over the sort of 2020 to 23-ish kind of period. Resource investors were not excluded from that by any means. They were sort of leading the charge, but it's sort of been dialed back as other issues come to the fore. How do you see the broader narrative at the moment?
I think it's progressing as we forecast. EV sales have been volatile, but they're increasing penetration globally. Everything else that I see, stationary storage is increasing rapidly and is going to become a huge driver of lithium demand and maybe even overtake EVs in time. So, I think it's progressing. What's really changed is just the supply side dynamics. We've gone from a chronically undersupplied market in many of those raw materials to now being oversupplied, and a huge part of that's come from Africa and China, and that's just fundamentally changed the game. So, no issues on the demand side of the equation. It's all about supply for me.
And what did it sort of leave you thinking about maybe a few of your exposures in the lithium basket in the portfolio coming back? Some of these names are notably shorted, not to the same extent they were last year, but have you taken a sort of against the grain view on them?
No, we've been pretty cautious on that sector for a while. I'd say we're starting to get pretty interested though. I mean, again, taking it back to the actual companies rather than getting too caught up in the macro, companies like IGO, which we don't own at the moment, but even at current prices, generating huge amounts of free cash flow from Greenbushes. That is sort of hidden within different corporate structures and reinvestment in the asset at the moment. But yes, companies like that, there's potentially some really good valuation opportunities emerging. Remain very cautious on the higher cost producers. We think you are going to need to be able to compete at lithium prices at or around these levels. But if you can find an asset like Greenbushes that's generating good cash at current prices with a potential for a rebound, then to us, that's when we start to get excited from an investment standpoint. And no one's talking about lithium, so it's always a good time to invest, right? When it's gone from being hated to no one's even talking about it.
Yeah, low on the cost curve tends to be the safer way. Just to expand for a second on what you said though, with the kind of harsh realization that we in WA are much higher, on aggregate on the cost curve than what we kind of thought we were. Is there any other kind of projects that start to tempt you, or is it a bit touch and go, and you got to kind of see where prices sort of sit and whether these companies can really pull in prices anymore?
I think there's going to be some really hard decisions that need to get made in the next 6-12 months for some of these assets, and I think some of them probably need to go into care and maintenance to see the market rebalance. I won't sort of go into which assets or anything like that, but I think Australia is at the top end of the cost curve at the moment, and some of the assets here probably do need to idle to see the market rebalance.
How do you think about cost competitive more broadly, not being specific to the lithium names, but it's something we'd spoken about on the show quite a bit lately with the the futurization of mines, the automation and all these sorts of things. But you've got very real sort of political kind of challenges, for the cost structure of Australian mining more broadly. Are these sort of concerns pretty pressing for you, or that you think they're sort of shorter term, quieter noises at the moment?
Oh, yeah. I mean, it's not what I focus on, but as a participant in the market and someone who's really passionate about the mining sector, I think that we really need to invest, and we need to have the right settings from a political and a social perspective to continue to enable the mining sector to keep on delivering the fantastic windfall benefits that it's delivered, really, since the 1800s to Australia. And it's really concerning to me when I go to places overseas and see their cost structures, the amount of infrastructure they have, and then to come back and see some of our sectors here, it makes me concerned as an investor as well. Yeah,
for sure. Let's talk about gold. So you said itching up towards 16% of the benchmark that you follow, and equally a big part of your portfolio. I know I've sort of dug into it quite a bit, but do you consider yourself a gold bull at all, or are you just working again from the bottom up and picking companies you like and projects you like?
No, I'm a Genesis bull, not a gold bull. No.
Thought I might hear that.
No, so I mean, we very very much take the view that gold is a currency, not a commodity. Against that backdrop, it's very hard to have a fundamental view on supply and demand, although you can try. People do. But we're confident in our ability to try and pick stocks within that. We'll obviously, when we're assessing valuation, we'll put in a range of different assumptions and look at what that spits out, including forward curves, broker estimates, and spot as well, and make our decisions on that view. But we're making decisions on a sector relative perspective, from a sector relative perspective. So, for the top holdings in our portfolio at the moment in the gold space, Greatland Gold and Genesis, we see 50% upside-ish relative to the rest of the sector for those companies if they deliver what we think they can over the next 3 years. And so that's the basis on which we invest and hold them, not a top-down view on the gold price.
All right, let's dig into it some more. So Genesis, you've been a fan for quite some time. Riley and the team have done a pretty stellar job since they grabbed the wheel 3 or 4 years ago now. That we go through it. You obviously highlighted a pretty bullish outlook. I think you've got a much sort of stronger view on Tower Hill getting mined before, I guess, consensus does. You've got bullish views on each mill getting expanded as well in due course. Can you go into a bit more detail on why you are such a fan of the company?
Yeah, sure. I mean, it's very simple, Genesis, in my view. There's 15 million ounces or so of resources and 3 in reserves, and 3 million ounces in reserves. The company, in our view, at the moment is being valued on a base case plan whereby the company produces at 325,000 ounces into perpetuity or thereabouts and extracts that 3 million ounces. Given what's happened with the gold price in the past 12, 18 months, even before that, that's just not a realistic scenario at all. If you look through Genesis's recent quarterly announcements, you can see very clearly that they're building ore stockpiles, they're building inventory. They are mill constrained at the moment. When you've got that much inventory, again, 15 million ounces of high quality inventory, and you're mill constrained, there is only one thing that you do to extract the cash flows, bring forward that NPV for shareholders, and that is to expand mills. And so, whilst I don't know, I strongly suspect that there'll be mill expansions both at Leonora and at Laverton in the next 12, 18, 24 months, and that will enable the company to bring forward Tower Hill, Westralia, and a number of other assets as well that are currently not factored in by the market. And that will, consequently result in more production, more cash flow, and a higher valuation. And we think the market's just really playing catch up here.
Pretty compelling. How do you anticipate the financing of the expansions with sort of cash and time that they'll build up? Do you foresee? I mean, we've spoken in the past about your views on companies with debt, just to sort of round out the argument on Genesis.
Yeah, it'll all be self-funded. They're generating very strong cash flows given the gold price at the moment. I think that's probably one thing that really has changed in the past 12 months, and the company will tell you this, is they were prepared to take on debt over the next couple of years to invest in those growth projects. There is no need for debt now, certainly no need for equity. And so we expect that to be all self-funded, and as a consequence, it'll have a great per share impact.
Genesis, if you guys are thinking of expanding your plant, or any other miners out there, if you've got work that requires the best engineering capabilities the industry has to offer, it's time to call out the big guns. Quattro Project Engineering.
JD, these guys don't just engineer projects. They make everything run smoother.
It's true, mate. Quattro works at the surface. They work underground, from blue sky concepts through to the DFS, construction, and keeping the whole thing running without a hiccup to your operations.
They'll design it, engineer it, source the gear, build the thing, commission it. Talk about expertise, JD.
Mate, if you're a miner out there, you might be expanding your plant, you might be modernising the circuit, or just tired of projects that drag on way longer than they should. Talk to the crew that actually gets the job done. Jeremy Palmer and the whole team at Quattro Project Engineering.
Engineering experts, no headaches.
Go Quattro.
And I think the sort of logical next place people would take that sort of debate is, when they have expanded mills, where do they look around just to fill it out if need be? I know you've said they've got a ton in resource and reserve already. Do you have a strong view? If you speak to Rowley, say there's no need for M&A? I know he's can make up his own mind, but how do you view that debate?
I think it will be assessed logically, and if there's opportunities that make sense for shareholders such as ourselves and the management team, who are highly aligned in their equity ownership of the company, then they'll look to execute on them. And companies like Magnetic, like Focus, like Brightstar, there's even some Anglo assets in that part of the world that I think could be interesting. There's a huge amount of value to be created and unlocked, and we'd support that. The obvious question I'm sure you'll ask me is on Volt.
You said it.
Just to preempt that, I just don't see it. I don't see the relative valuation stacking up too well at the moment from a Genesis perspective. I think if the Volt portfolio was singularly focused on that King of the Hills asset, potentially that's when it starts to look more interesting from a Genesis perspective. But back when there was a lot of speculation about that occurring, the gold price was much lower, and what that means in practical terms is the value of the mill was much higher. So now Genesis can go out and build or expand their mills for a nominal value of money compared to the excess returns or the cash flow it's going to generate. back then the value of that mill was much higher in my view. So I think a lot's changed there. I think at a point in time potentially, but I think there's a lot more smaller and more value accretive deals to be done first, and they also have to be assessed in light of what we talked about earlier with their own portfolio. So I expect them to be active in the coming years, and that will form part of the growth. What they really need, in my view, is some more grade around Laverton. So if there was an asset that added some grade, 2-3 grams per tonne to that mill, that could really see it produce some fantastic cash flows, and also oxide material as well. So they acquired an asset called Bruno Lewis. Good amount of oxide in there, as many will know. Oxide goes through the mill much faster than typical hard rock ore, and so your mill capacity, whilst it might be 3.3 on paper or whatever the number is, you can often get up to 25% more if you're feeding oxide material. So that's another lever for some value creation there.
You mentioned Greatland before as well, and you did a write-up not too long ago calling it the deal of the decade, and I think you added that Havieron is the best undeveloped resource in Australia. Am I right?
I have had some people try and correct me on that since, but something about an iron ore asset. I'm not sure, but yeah, sure, I'll stand by it. Yeah.
Let's talk about the deal, right?
Yeah.
So, by all accounts, it's been a pretty cracking deal. But firstly, just curious to hear, it is still UK listed at the moment, but you've been able to, with the anticipation that it comes here in the June quarter, get in already?
Yeah, that's right. So we can invest up to 10% of our funds in what we call pre-IPO opportunities. Fits comfortably in that sleeve. Currently AIM listed, as you say, and looking to list here June, July, as we understand it, which we think will be fantastic for Aussie investors to be able to invest in Telfer and Havieron. It's an amazing asset.
For sure. And the natural question that comes to mind is 20 million tonnes per annum at Telfer. Obviously, there's a mine plan in place, a 15 sort of month mine plan that they've put forward already that is meant to spit out sort of over 400,000 gold equivalent ounces, a bit under 400,000 gold ounces. And, the expansion sort of starts to happen after that. Havieron in due course should come online. But how do you think they go about filling that mill? Do you have any reservations about it? Do you think from the offset they're going to be filling it or doing a train and a half type thing?
Yeah. I think the processing solution is still up in the air. There's still work happening to determine what the best outcome is. And the company will go through that engineering process. None of this stuff happens overnight. But what is very clear and was not clear to the market 6-12 months ago is that there is not going to be a production gap between Telfer and Havieron. That was a big concern, that they'd have to idle both trains. There wouldn't be any free cash flow or production for a number of years whilst Havieron was being developed. Based on their recent resource update, mine plan update to a certain extent, that is completely off the table. I think they'd be able to produce from Telfer at an annualised run rate of over 300,000 ounces per annum of gold equivalent for the next 10 years, based on the open pit stockpiles there, as well as Telfer underground proper and West Dome underground. So we see that asset continuing to generate very healthy cash flows that will then fund Havieron, to your point around Genesis earlier, and what really creates value in resources. That self-funding is fantastic.
Yeah, and they've got pretty hefty stockpiles as well. Some low grade, some higher grade as well. That should help them ease their kind of way through that. How do you kind of benchmark their value? Obviously, sort of 400,000 ounces is a decent amount. I think last time I looked in Aussie dollar terms, they're capped at 2.7 or 2.8 ish. Do you mentioned an upside there, 50% before.
Yep.
Is that kind of how you're thinking how they should play in the Aussie market?
Absolutely. I think it gets re-rated when it lists here based on where it's currently trading. And people getting more comfort around the sustainability of the production profile at Telfer. There's still work to do there, but the cards are out. When we look at valuation for a company like that, we'll assess it on a range of different metrics. Ultimately, it's NPV, but in this case, you need to look at a sum of the parts NPV for the existing Telfer asset and then Havieron at the back end, given that it's not currently contributing to cash flows or production So that's the way we assess it. We give a value to Telfer for the operations there, that 300,000 ounces or so over the next couple of years, and then layer in Havieron over the top of that.
If we look at some of the other sort of major gold companies in your sort of ballpark, you've said in the past that you don't hold Perseus and WAF, and for jurisdiction risk, right? But these companies have, to date, they've performed pretty strongly. But if you look around that part of the world, there's been some pretty big losses on companies that didn't draw the right straw, so to say, in West Africa. How much of an ingrained view is that? Is there a point where value kind of beats out on these sorts of things? What's your sort of thinking toward African and jurisdictional risk generally?
We have an attitude across the market that we see every single stock as an opportunity for our investors, as long as it meets a certain base level of criteria with respect to things like ESG and alignment of the board and the management team. And so we never rule anything out. We just haven't felt the need to invest there, given the plethora of opportunities available in Australia and in particular in WA. Continue to meet with those companies. Jeff and Richard have done amazing jobs and added a huge amount of value, added massive amounts of cash to the balance sheet that you just can't ignore, no matter where the asset's located. And, from my read of the situation, it seems like they're going to continue to do so. So if we'll continue to meet with them, if they start to stack up, maybe when Genesis hits $8 or something, we'll look at if we redeploy that capital somewhere else.
Very interesting. You speak a lot to quality management, and you just mentioned it there again with two teams that have demonstrated. You've backed it in Genesis and a host of other names. I guess the way I'd frame this question is you've been a manager of money for the better part of a sort of decade, and in the finance world for 15 odd years or so. How has the thinking toward backing proven management teams changed over that journey?
Yeah, I think there's two things that I value more highly the further I go in my investing career, and that is good balance sheets and good management teams, or conservatively managed balance sheets, I should say. Cannot be overstated. And, just knowing that you have a team that's highly aligned, highly competent, and you can believe what they say is just, it's a non-negotiable for us in investing. And that's why we find that a lot of our portfolio is invested in companies both within the industrial space and resources, where management are long-term owners of the business, have significant skin in the game, and have been there for a decent period of time as well.
And the point on debt is super fascinating, right? And it feels more sort of it rings louder than ever right now with everything that we've seen, like the speed at which share prices can fall, commodities can fall. I know you said it when we spoke in Sydney a year or so ago, but a super clean balance sheet was your outlook, in particular for single asset companies. I'm just keen to hear you expand on that, because I think it's a point that's not often well enough appreciated across the market, and I'm keen to learn more about it myself.
I think, corporate finance 101 will tell you that leverage is good and that it increases the equity IRR on a project. In reality, that doesn't work, and that particularly doesn't work in resources, and particularly when you have single asset resource companies, as you have highlighted. It's not to say it will never work, but the track record speaks for itself. It's good for one set of people, and that's the people that raise money, the investment banks, because they get multiple cracks of the cherry whenever this plays out. And so, I
need to say where we're recording this interview from.
No, that's right. Shout out to it. But so for we'd much rather companies, particularly with interest rates where they are at the moment, pick up the phone and call us. We're here to provide equity. And we don't want to see hedging. We don't want to see commodity or financial risk or leverage on top of commodity price risk and operating risk as well. We just don't think it's needed or appropriate in many instances. And so it's a key red flag for us, I suppose. Yeah.
The point on hedging is one I want to tap into as well. It ebbs and flows with the commodity price, and right now it's not in fashion to have a big hedge book, that's for sure. What do you make of the trend of people actually, buying them out? You've got it. Say there's a company you're invested in that has a hedge book.
Yep.
Are you a fan of them cancelling that out? How do you think about it?
Yeah, I mean, it's easier to say you're not a fan of hedges when the gold price is ripped and they're on the nose. They definitely have a place from a risk perspective, and I think they've been used very effectively in the past by companies like Evolution, who acquired assets, put in place hedging, paid it out, did a great job. But philosophically, at the moment, if you're investing in a gold company, it's because you want exposure to the gold price, and I think having a management team that might have actively bet effectively against the gold price through a hedging profile is a little bit counterintuitive. So unless there's debt involved, which goes to our earlier point, I really don't see the need for it.
Let's talk about a couple other goldies. Some of them have quite a bit of hedging in place. I want to talk about Bellevue and tie in Spartan and Ramelius. You made the call when we spoke, and I think you're going to love hearing this. I mentioned it to you just before, but I think the way you sort of framed it was, in about 3 or so years, let's have a look again at what the grade is between Bellevue and the grade at Spartan is. And looking back, I can't remember if Pepper had been discovered or not at that point in time. But obviously Spartan has gone from strength to strength, and I'll disclose that I own a couple Spartan, but the other side of the coin there on Bellevue, that company's had a bit of trouble. They paid down a portion of their debt, but ramp up is hard, single asset companies and all that, like you mentioned before.
Yeah.
What's your view on Bellevue? I'll disclose, maybe this interview comes out later, but they're in trading halt right now when we're recording this interview. They're in an interesting position though, right? They're one of the weakest performers today versus their benchmark, but that does to an extent make them attractive, right?
Absolutely. Yeah, I mean, we're all waiting to see what happens there. We're not currently shareholders, but we know the guys really well, got a lot of respect for them. They've created a lot of value. It looks like a great ore body, and so there's potentially an opportunity there. I think just in terms of what we'd really like to see from that company, from a disclosure perspective, is what's changed with the ore body. There seems to be that there's the ore body that they thought was there fundamentally, potentially, is a bit different. And so, it's hard to, at this point in time, have confidence in production targets and things like that without a recut in terms of stope sizes, dilution. Is the grade appropriate? Are all the modifying factors appropriate? All that sort of stuff. So we'll look forward to engaging with the company in hopefully the coming weeks or days and forming a view on that. And if there's a potential opportunity, I think there absolutely is. That was my view sort of, before them going into trading halt. There's been a production downgrade since then, but, the ore body's still there. We're in an all-time high gold price environment. They've got debt, they've got hedging that needs to be cleared. So we look at situations like this as a fantastic opportunity for our investors.
Yeah, it's an interesting one. Very keen to see how they come out of this situation. On the flip side, we've got Spartan, who just tied up the deal. Keen to hear your thoughts on what you make of the deal and the sort of pro forma entity moving forward.
Yeah, I think Simon Lawson and the Spartan guys have to be congratulated for, not manufacturing, but, delivering such a great amount of value to shareholders, and then rolling into Ramelius and the value creation that they've seen since then. Very rarely do you get two entities combine or merge like that and see the share price perform as well as it has. And I think that's a real credit to Zeppi and Simon, the way they've communicated that to the market. And so on and so forth. We don't own either at the moment, but
there might actually be synergies in this deal.
Yeah, who knows? But it was an obvious one that had to happen, and it's good to see. It's good to see logical deals happen. Is the thing I'd say there? Yeah.
And if we look across the gold space, M&A discipline has sort of been a theme of the miners. It's been sort of hammered into them since I guess the downfall of the 2012 cycle that peeled off, and you can sort of say that for the mining sort of complex more broadly, but we have started to see more and more deals in the gold space. What do you make of the trend for these bigger, now kind of mid cap deals? Do you see it playing through to the smaller end? Does it worry you? Does it kind of excite you? How do you think about it?
Oh, it excites me from an investment standpoint for sure. Yeah, I mean, would I be invested in a large cap company with very fully valued paper that was lacking production over the long term and had a short reserve life position? I wouldn't be investing in those sort of companies. But if we can find companies that have high grade assets that they're drilling out, like a Spartan, that's a fantastic place to be because there's an immense amount of value creation that can happen there. So one of our recent investments in the portfolio has been a company called Greatland Gold. They previously Labyrinth, and they've got a suite of fantastic assets that would make sense in other people's hands, and we expect them to drill those assets out, find more gold, and if it's not appropriate for them to monetize the asset through developing their own mills and mining them themselves, then they'll look to create value for shareholders by selling those assets. And so it's an opportunity for us to recycle some of the capital from a Spartan into something like a Gorilla, and Simon Lawson's involved in both.
Some of those assets they might have only just picked up as well. So how do you sort of see the timeline? Say Vivian, for instance, already just going hammer and tongs with the drill rig and churning out results and stuff. Yeah.
It's interesting, especially given that was obviously a Ramilius asset as well. I think that history has shown us in WA Gold that having a different view on assets, on the geology, turning the drill rig around, drilling in a different direction, taking a different lens on assets has created an immense amount of value. And so I wouldn't write any asset off on the basis that it's just been acquired for a certain price. And we've just seen this so many times. Yeah,
for sure. Let's talk about a couple other commodities. So to start with copper, I know you said in the past you're a fan of the copper dynamic. Let's go to North Queensland to start. AIC Mines, Aaron Colleran and the team, at the smaller end of the spectrum, but sort of building a company kind of brick by brick. Are you a shareholder there at the moment?
We are. Yep.
What are you sort of thinking going forward about the assets they've got, the ability to kind of scale up production?
Yeah, we're excited about A1. I think it's a long-term story there. It's nothing's going to happen overnight. They're developing an asset called Jericho, which will double production on a 3-year view. That's the reason why we are invested. It's a tough road to get there. It takes a long time to get these assets built and developed, but once they get there, there is going to be an immense amount of value for shareholders. We would like to see some more consolidation in that part of the world as well. There's a number of smaller assets that probably don't make sense to be listed as standalone entities. And so part of our thesis there is that Aaron will be able, and the team will be able to execute on some acquisitions over time and increase the size of that business. And to be frank, we've probably been a bit frustrated, and I think Aaron would say he's been frustrated as well with how long it's taken to be able to execute on some of those. But you can't force this stuff. You have to act in the best interest of shareholders, and if people want silly valuations, then you need to be prepared to walk away.
Yeah, for sure. You kind of get the impression it's going to be an overnight success story that takes kind of 10 years.
I think that's right. That team. Maybe 2026 story. Yeah.
If we go to the other end of the ASX copper names, Sandfire, they've it really does seem overnight become a very large company, and they've since new management came in late 21, early 22, the assets have started to perform. Mateo's sort of come online and it's doing well.
Yeah.
What do you think about the next leg for that business?
We're not currently investors. I think Brendan Harris has done an amazing job with that company. What would really sort of change the game for us, and speaking as a former geologist here, is some exploration success in bots. I think they've only very recently come to terms with some of the genesis of that ore body and what that means, or the implications of how the ore body formed for exploration. And we're pretty excited to see what they can do and tracking that closely. There's obviously further acquisitions they could make. I'm not across the opportunities out there for that company. It sort of sits above our market cap spectrum, but they've done a great job. And I think given the credibility now and the valuation that the market's ascribed to that business, he's got a lot of options to go out there and do something else. So I'm excited to see what that is.
So maybe it'll be one of the other companies you're holding. If we look at some of the smaller names, we've seen more and more of these Canadians sort of come across. But what are the copper names that kind of get you excited at the moment?
Yeah, it's crazy when you look at the market at the moment. It's every single gold company. If you're producing any gold at all, it seems like you've got $1 billion market cap and everyone loves you. You transition that to base metals, and there's a number of companies that no one cares about. We own several of them, and we're excited about their prospects. So AMI, Aurelia Metals, we own Firefly and A1M, as you mentioned earlier. Of those, the one that I'm most excited about over the short term is Aurelia. That company today has got a market cap, I haven't checked, it's probably down 10%. It's
Don't look.
yeah, of around $350 million. They've got close to $100 million of net cash on the balance sheet. They've got a huge amount of production growth coming up from a high quality asset they're developing called Federation. I was on site 3 weeks ago up in Cobar, which was great. I mean, it's all coming together very well, and we see that business generating $100 million of free cash flow on what is today an EV of 250 with a substantial mine life. And so it's opportunities like that for us that are really, really interesting. And, potentially, if we're sitting here in 2 years' time, some of these companies might be more mainstream, like we're talking about Genesis and Volt and some of the other golds at the moment. We just think that there's a massive opportunity there.
Some people have sort of been banging the table on consolidation in the Cobar. Is that something you think needs to happen for some of these names? Is it way overhyped? What do you kind of make of, there's some bigger names, there's a lot of smaller names.
Yeah, there's a couple. So Polymetals, what else? You got Peel, Mac as well. Look, we don't invest on any company on the basis that it's going to be taken over. We like to invest in companies that can stand on their own 2 feet, generate a lot of cash, and Aurelia certainly fits that bill. I think Peel and, makes a lot of sense for a couple of companies in that region. But there's just no onus on anyone to really move. Where's the pressure point to say, to bring companies together? M&A, I find anyway, it's you need someone to be heavily motivated for it to take place, and sitting there trying to time stuff, it's very, very hard. So we're not sort of expecting anything imminently there, but there are deals that obviously do make a lot of sense, and particularly with Peel. I mean, they've got some pretty good resources and they don't have a mill, so you don't need to be a rocket scientist to work out that there's synergies there, and they're probably not of a scale that they can finance their own mill.
Yeah, it speaks to your point on a sort of forced or pressured seller in Newmont putting the clock on themselves with Greatland, and it leading to a great outcome for one party at least.
Yep.
Another company and another commodity that I'm keen to get your thoughts on is Nexgen. This is, I think in your words, the best undeveloped resource of any commodity globally. It's
as distinct from Havieron,
to be clear, it is a cracker by all accounts. Let's start with the resource. They've done drilling lately, and people have got pretty excited about it. I mean, the production profile that was already kind of established was quite enormous. But what does that kind of add to the story for you?
It's a good question. I mean, actually on a spreadsheet, I don't think it adds much, right? Because you're not going to build a bigger mill. You're not going to increase the production rate for the first 10 years in our view anyway. So I don't think it adds much from a spreadsheet, but it does make it much more strategically compelling for someone like a BHP who will take a very long-term view on these assets and the expansion potential down the track. So I think that part of the world is underexplored, and they've demonstrated now that there's a highly prospective second asset there that should in time be a mine. But the thing that's really proving difficult there isn't the geology or the quality of the resource, as you know, it's the permitting process and getting it to market. So we're not expecting production until 2029. There's no free cash flow until then, and in this sort of environment, people want free cash flow. They want to see free cash or cash being added to the balance sheet every quarter, and that's fair enough. But it's hard for those development companies at the moment. We've seen Nexgen fall from $12, $13 to $6 today. Nothing has changed in our view, and so you can probably imagine we're taking advantage of that for our investors at the moment.
What sort of uranium price will you flush through the decks long term when you think about it, and you build your MPV of the company? Yeah,
so we use 85 in our MPV's base case. Obviously, once again, do a range of scenarios around that. What's spot today? 64. term price is 80. So we do see it going up over time. We think 80, 85 is the minimum incentive price that's required for a brownfields project, like a Paladin, Langer Heinrich as an example. And probably 90 to 100 is the incentive price for greenfields projects that will be required post 2030. So that's the way we're thinking about it. It's been a frustrating one, the uranium trade, but we're very confident nothing's really changed from a fundamental supply and demand perspective, and so we're backing ourselves in on that one.
Politically, there's been a fair bit of upheaval in Canada, at a federal level over the past kind of 6 months, and they've got an election at the end of this month already. Does that kind of give you hope, or have you heard any kind of whispers that there's a different regime? We'd already seen the Carney, the new progressive, if you like, leader, trying to do what they possibly can to win a few votes and push mining along the kind of trajectory that it needs to be for Canada. And you can imagine on the other side of the aisle, it's even more of that kind of voice. Do you have faith in that kind of view?
Do I have faith in politicians? I mean, for an asset like this, I mean, the world needs the uranium. It's a fantastic, high quality resource with low environmental impact. It's going to benefit the local communities. It's going to benefit the government. It's going to, produce low carbon electricity for the world. I see no reason why it shouldn't be accelerated and, investment allowed. And I'm hopeful that it gets accelerated, but I don't know.
Not going to hold your breath on that one.
No, I won't hold my breath.
If we come back to Australia on the uranium names, there are some pretty hefty shorts on Boss and Paladin at the moment. What do you make of the sentiment around the uranium trade being so kind of whipsaw over the past year?
Yeah, it's a frustrating one. I think a lot of people liken it to the lithium boom. I've spoken to a lot of investors. Often my mates will call me up and say, "Hey, what's this uranium thing? Is it like lithium? 5 years ago, should I invest my house in it?" And they're just so fundamentally different because with lithium, the demand side can move around much more. It's dependent on EV sales or stationary storage sales, all that sort of stuff, which is susceptible to consumer sentiment in any given year and what's happening in global auto markets. Once you turn a nuclear power plant on, you don't turn it off, right, because of the capital cost involved. And so being able to forecast demand for uranium is very, very easy. My 4-year-old could do it pretty easily. It's 2 to 3% per annum, or slightly under at the moment, but moving to that level. And so, a much more steady demand outlook. And then on the supply side, we've seen just a huge explosion in supply that, frankly, we didn't see coming out of Africa in lithium. And the Chinese have once again proven their ability to bring on huge amounts of supply very quickly to fulfill their needs. In the uranium space, we've just been talking about Nexgen not producing until 2039. There is assets like Paladin and Boss that are struggling to come back into production as quickly as what we thought. So on both counts, you're just looking at a very different market. And we're still burning roughly 25% more uranium every year in power plants than is being drawn out of the ground. So for us, that's just a fantastic setup.
Do you put it kind of to market dynamics as well, the impacts of sort of like faster money, if you like, that these short positions can build so quickly? Or do you think it is kind of, to your point, there are quite a broad way of playing a short-term bearish outlook on uranium?
Look, I don't know about the short interest. I mean, with both of those companies, they're going through ramp-ups, and as we all know, any company going through a ramp-up is a very high-risk time, and more often than not, things do go wrong, unfortunately. It's rare for a company to bring on an asset very smoothly, and so I can understand why there's that level of short interest. It does surprise me, though, given where the uranium price is and what the outlook is over the medium term. And certainly if there's any sort of positive news in both those companies, then investors will be, or short sellers will be in for a pretty rude shock, I think. But, particularly in the case of Paladin, there's issues potentially around funding. I'd say I can see it from both sides.
If we look at a couple more commodities quickly, just to fly through, you called met coal your best or your highest conviction pick, I believe, for 2025.
Yep.
Standing strong?
Yeah, it was always a Q4 story, man. Yeah.
It's going to come
India's
good.
coming in the market Q4. Don't worry about that. Yeah.
When you look around the names out there, Whitehaven, like just looking at it earlier today and seeing the metrics on which the 30% sale got done, you know, that outweighs the market cap of the whole company right now.
Yeah.
Is that one kind of lens you look at it through, or do you think, you know, with contingent payments and other sort of, you know, costs coming up and where they are, given they're a sort of met and thermal coal player, there is pretty valid concerns?
What do you mean by concerns? Like,
For the company being able to make some of those payments and stuff?
Yeah, I mean, gosh, with the coke and coal price where it is and the thermal coal price where it is, I mean, it's no secret they're not generating a huge amount of cash. Do we think they need to raise equity? Absolutely not. We think they'll get through and make those payments, no problems. And, you know, you have to look at the counterparties there as well, right? They're not exactly, you know, you're not dealing with Glencore. So I think that'll be fine. What's really interesting for me is just what's happened to the met coal market and the fact that you now have Coronado and Stanmore in far worse positions and really, I mean, if Whitehaven are only generating a little bit of cash, then companies like Coronado and Stanmore are in a world of pain. And so what does that mean for royalties, for costs in the sector? What can we do to increase the overall competitiveness and what does it mean for M&A as well? So I think there's some great opportunities there. The best time to invest in a commodity is when it's in the cost curve, like lithium now, like coke and coal now. It's not when it's trading 10 times marginal cost like lithium was at 80,000. And so these are the sorts of periods that create opportunities for people that want to take a 3-year view.
Amazing. One other commodity I know you'd talked about and you were quite excited was kind of bauxite, aluminium supply chain, and Metro Mining was the name you'd mentioned. Now these guys have leverage in certain sort of parts. They you know, previously were heavily operationally and financially leveraged, but things have kind of changed there. You're still a holder and still sort of along for the journey? Absolutely.
Yeah, we love the metros. Another good example of why debt is very good for investment banks and fees and increases the number of shares in issue. There's a lot of shares in issue for Metro Mining, and we own a fair proportion of them. We're very positive on the outlook there. Operations, as far as where we're continued to ramp up really well post the wet season. The bauxite price has held in incredibly well. We don't expect spot bauxite pricing to stay where it is forever. We value the company very conservatively, and on that basis, we think the business can generate 125 mil of post-tax free cash flow per annum. The current cap is, I don't know, 250, 300. And so, we're really looking forward to seeing a couple of quarters, hopefully the next 2 quarters, where there's $40, $50 million put away to the balance sheet, and we think that that will see a big reaction in the equity, or it should, because people have to stand up and take notice then.
Fantastic. I think I've taken more than enough of your time, Fisty. Thanks for making the time for us and coming on Money of Mine.
No worries. Thank you.
Awesome. Big thanks to Fisty for joining us on Money of Mine, and I hope the money miners out there got a kick out of that one. And a massive thank you as well to all our partners. Firstly, JRX, get your tickets, discounts in the show notes. The conference will be at the back end of May. And to the legends at Mineral Mining Services, Grounded, Sandvik Ground Support, CRE Insurance, K-Drill, WA Water Bores, Quattro Project Engineering, KCA Site Services, Black Diamond Drilling Services, and Cross Boundary Energy. Hooroo.
Hooroo.
The information contained in this episode of Money of Mine is of general nature only and does not take into account the objectives, financial situation or needs of any particular person. Before making any investment decision, you should consult with your financial advisor and consider how appropriate the advice is to your objectives, financial situation and needs.